To the Full Tracy Money Audio Commentary. This is Owen Tracy recording, and it is 4:16 p.m., and that is Central Time, and today is May 27th. Well, I thought I would kick off today, and I would look at the 30-year in Japan, because it contracted by 20 basis points, which is a pretty dynamic move. Now, when I was recording the big picture long-term audio on Friday, I wanted to look at the markets through the lens of the jump in yields, because what we've seen is no real regard for fiscal probity from governments, and the bond markets are revolting. This has been a significant advance from pretty much zero in 2019, and definitely a lot closer to zero in 2016 to 3% is a really significant move for one of the most heavily indebted countries in the world. Well, a lot of that had to do with trying to get inflation moving again in Japan. And to a greater or lesser extent, they've already been successful in that regard. So they're beginning to consult with buyers about really how many bonds they should be issuing. So the possibility that there'll be less supply has put a floor under the market. And then we've seen that the 10-year Treasury yield was also down in quite a dynamic manner. And that was really on the back of some speculation from the Treasury that they'll issue fewer bills as they start to approach the debt ceiling. So the 10-year yield was down another 6 basis points. So this has been quite a significant retreat from the peak that we saw last week. Now, when we look at this on a 10-year basis, we can see that a range has been underway for at least the last 2 years, and arguably since the initial peak in 2022. And the yield right now is really not all that far away from where that initial peak was. So it's certainly an interesting environment right now, where the bond market is reacting to even a whiff that there'll be less supply. And then the stock market is reacting really favorably to any possibility that there will be a contraction in borrowing costs. So we're certainly in an interesting environment, because a modest rally in bonds was followed through today because, of course, yesterday was a holiday, with a strong rally on Wall Street today, and then a pretty decent rally in Europe as well, particularly since the majority of European indices were not closed yesterday, and they were also up about 1% yesterday. So